Friends, I captain episode. So far in our earlier episodes, we have understood the concept of stop loss, good patience, and various periods of holding of equity shares, such as short term, medium term, and long term. Long term holding of good quality equity shares not only rewards surprisingly well, but more than that, adequately demonstrates the power of compounding, which we did discuss earlier on. I will show you by an example later on, of course. And friends, do remember that equity shares, apart from capital appreciation which comes upon selling, also gives regular annual returns, and that is by way of dividends. We have also understood various objectives to be attached in all three forms of holding periods, and accordingly book profit with a strict adherence to the stop loss limits. Friends, as promised earlier, we shall now study the salient features of a company's balance sheet in good detail. Friends, now I give you my presentation of the balance sheet. A balance sheet is a statement of the financial position of a business that lists the assets, liabilities, and owner's equity at a particular point in time. It is called a balance sheet because at any given moment, each side of this equation, which is assets and liabilities, must balance out. Assets are actually what company owns and liabilities are what company would owe to others. In other words, asset minus liability would be equal to owner's equity. As I just said at a particular point of time. And friends, what is that time or date? It is normally prepared, audited, and published for all the shareholders, for the general public, and the authorities. As on the last date of a particular financial year, the company follows, and in our country, normally it is 31st March. A balance sheet being a summary of all of the company's assets and liabilities at any particular moment shows us how much money the company would have left over for its equity shareholders, who are the owners of the company, if it sells all the assets and paid off all its debts. And that part is also known as owner's equity. Owner's equity normally would be equal to original equity share capital which was invested in the business by the prevailing owners at that time, plus the reserves which have accumulated over the period of business. In other words, again I repeat, assets minus liabilities will be equal to owner's equity. Now let us see in detail what is there in a balance sheet. There are three different sections in a balance sheet: assets, liabilities, and owner's equity. So first, let us understand assets. Assets in itself are further subdivided into three sections broadly. First one is known as the current assets. Current assets are what your business plans to keep for a short period of time, often less than 12 months. They may include cash at bank, short-term investments made by the company, stock of goods which have been manufactured, produced, and kept in our inventory, sundry or trade debtors, debtors from whom we will get some money and petty cash. Second would come fixed assets, also called non-current or capital assets. And these are assets that your business plans to keep, which includes buildings, shed spaces, land, which are all necessary for the business. The plants and equipment which have been installed, necessary for the manufacture of the goods of the business. Motor vehicles, trucks, trailers, office equipment. In general, I have given you this. There could be many other also. The third one is called intangible assets. Now, intangible assets are something which you cannot actually touch. They include the following: intellectual property, which is actually knowledge, information or processes, which is peculiar to our business. Trademarks and patents, which also have a value, which are formally registered and definitely valuable to our business. And then goodwill, very important factor actually. Reputation and performance of a business, which is called business value. We now come to the second aspect, the second column, as we said, liabilities. This is the next column of the balance sheet, and this is subdivided into two sections in a broad manner. First one is called short-term liabilities. These are usually those items you would expect to pay or could be expected to pay for during the next 12 months. They may include overdrafts from the banks or from any financial institutions, including the overdraft charges, short-term loans taken for the working capital of the company, sundry or trade creditors, those people to whom you have to pay. The second one is known as the long-term liabilities. Long-term liabilities are debts not payable within 1 year of the balance sheet date. It can be paid in a longer period of time. Long-term loans, secured bills, any loan given by any director to the business, residual value on leases due in more than 12 months, and could be some other factors also. I'm giving you in a very broad manner. Finally, we come to the owner's equity, which is the third item, which is actually assets minus liabilities. This is also called shareholders' equity. The equity, capital plus reserves, which belongs to the owners of the company. It is that residual portion of a business belonging to the owners after deducting total liabilities from the assets. This is the amount of equity available, depends on the prosperity of the business, how much the business has prospered over the years and how much reserves have been built in, and those reserves with the original equity capital definitely belongs to the owners. The next factor is also very important, and we must discuss this, which is called depreciation. It's a compulsory concept to consider when we interpret our balance sheet. Sometimes it is also mentioned in the profit and loss account, which we will discuss in the next episode. Every time the business uses a fixed asset, it can be an office equipment, it can be a vehicle, some of its value is always lost. Our tax law requires a company to spread the cost of the asset over the years during which it can be used. It can be 5 years, 7 years, 10 years. So that after that period, either the asset can be renewed, replaced totally, or it can be serviced, reserviced, and it can be used again and all that will definitely incur a cost. Therefore, after every year, the allocated annual cost for various assets which value can reduce year after year is called depreciation. And this may be a notional figure, but it is normally taken from the profits and it is kept separately accumulated to be used whenever necessary for replacement, as I said, for the particular asset. Sometimes reservicing of the particular asset, sometimes refurbishing of the particular asset. It all will depend upon the asset itself. Just for your information, this depreciation also provides the company with some rebate on income tax. So friends, to conclude our discussion so far, we have fairly discussed the salient features of a balance sheet and its broad elements. In due course, we shall also study the actual balance sheet, some figures of few companies, which will give us a good practical understanding. And in our next discussion, we shall take up the company's profit and loss account, and we will discuss the salient features of that as well. Friends, if you have found this discussion knowledgeable, please do subscribe to my channel if you have not done so. This will ensure timely receipt of the future episodes. Please also put in your comments and your queries, if any, in the space provided. I shall definitely try and reply to all of them. See you again soon, friends. Have a nice day.